the idea of velocity banking is you're using someone else's money to pay your loan, right? So you're using a loan to pay a loan, but both of those loans are being facilitated by one income.
Yours.
It's your income. Yeah,
Your household income.
You're double leveraging yourself. And I guess some people might think, oh, I'm already leveraged once. Why not just do it again? Because it's the same collateral, right? If I'm late on my mortgage, I'm going to lose my house anyway. So why not just double up?
Like, I feel like I have to jump and show you something because it doesn't make sense to me, the math. Like looking at
Velocity banking, the mortgage hack that lets you pay off your mortgage in 5 to 7 years, saves you hundreds of thousands of dollars in interest, and basically unlocks financial freedom overnight. Sounds amazing, right? Well, Jason and I are here to break down why this mortgage hack might actually cost you more money, more stress, and more risk than it's worth. And don't worry, we're going to offer you a solution that's just as effective and way less risky. Welcome to The Clear Close. We're the mortgage experts that help you get clear to close on your next mortgage. And today we're on a mission to debunk velocity banking.
Yes, let's do it, Peter. Let's debunk this. I'm tired of hearing about velocity banking. Don't get me wrong. If you want to talk about it with me, I'm okay with it. I'm definitely not a believer once you see the end of this video.
Okay. All right. Before we move on, if you've heard of velocity banking, please write in the comments what you think it is and if you are thinking about using it or not. We'd love to hear your thoughts and love to have a conversation with you down in the comments. Okay. So, quick summary. What is velocity banking?
So basically, velocity banking, from what I'm understanding, is instead of making normal mortgage payments, you're going to open a HELOC, a home equity line of credit, and dump all of your income into that line of credit. So basically, you then use that HELOC like a checking account to pay bills from it, your normal expenses, things like that, instead of using a traditional checking account where your paycheck comes in. And then because of that, it just keeps pushing down, I guess you can, for a shorter, like a set period of time during that month so that you pay less interest on what your mortgage balance is. You're reducing the interest charges you pay and technically pay off your home faster. In theory, it really does sound like a cheat code. And when I started looking at it and seeing some of the people talking about it, they make it sound so good.
Yeah,
But in practice, it's not simple at all.
I guess there's always a market for people wanting to shortcut life, shortcut the hard parts of life. And so velocity banking could be one of those things where it sounds like, it sounds like, oh, this is a secret that no one wants you to know. Like the banks don't want you to know that you can actually use their money to pay down your mortgage, right? Like it sounds so good.
I mean, whoever came up with the name velocity banking, it just sounds so good, you know?
Yeah, it does.
It's just like,
Yeah, you want to go fast.
I feel the need for speed.
Right?
it's like, but nothing good in life is easy, right?
Mm-hmm.
Like, or what is it? What I keep saying this all the time too. Is like, you know what I'm saying? What
Yeah,
do
I
I
think the
always
term,
tell people?
I think what you want to say is nothing worthwhile doing is easy.
It's like you're borrowing money to begin with. You didn't have cash to buy the home outright with your savings, right? It's like there's no way in hell I could have done that too. So it's like you have to borrow. You borrow smart and you budget. But there is a cheat code, and it's actually simple. We'll get to that point.
Yeah, so let's dive into the points why we think velocity banking isn't the greatest solution for you. Number one is when people were talking about velocity banking like a lot a few years ago, it started popping up. And definitely the conversations online about HELOCs at that time were mainly variable interest rate HELOCs. No one's talking about fixed rate HELOCs until literally we started coming onto YouTube, right? So like I think 99% of the people who entered into velocity banking, they did it on a variable interest rate. And at that time, probably it made sense because rates were so low.
If it's a variable rate HELOC that you're in at that time, right? And most people are using variable rate HELOCs for the velocity banking side, your like payoff hack kind of collapses because again, say you're one of the early adopters and it worked in the beginning because it was a lower interest rate technically, and you had a HELOC for 4% back in 2021. Yeah, I remember like 2019 to 2021, I saw a lot of HELOCs right around that range in the 4% range. So it's probably 9, 10% 3 years later and you refinanced out of it. Hopefully.
Most people who got this 3, 4 years ago, they got into velocity banking on a variable interest rate HELOC. Like you've exposed yourself to the greatest the greatest rate hike in modern history. You know, like if your HELOC was at 2 or 3%, 4%, like what Jason was saying, and then 2 years later, the Fed hiked it all the way to like right now it's at 7.5%, and that's when it came down. It was almost like 8, 9%. So you experienced quite a price shock or like a payment shock.
It's not simple doing velocity banking because, like, as the markets go up or down, you're vulnerable to those swings. And a lot of things can happen outside of just your mortgage payment. It could be your job, right? It could be your family. So it's like those are the unknown variables you can't account for on that spreadsheet when you're doing your velocity banking calculations.
Like I'm sure like you if you guys have been watching this channel for any amount of time, you know that Jason and I love talking about fixed rate HELOCs, and that's something that we offer on the platform as well. Shameless plug, we do have a link in the description of this video. If you want to get a fixed rate HELOC, then use that link. You can schedule a one-on-one call with us, and we can talk about those options for you. So yeah, those exist, and you might be like, oh well, what about a fixed rate HELOC? You're not exposing yourself to the ups and downs of the market if you get a fixed rate. Well, that leads us to our second point, which is velocity banking is very complex.
You're shuffling money. You're like timing deposits. You're paying bills out of your HELOC and you're constantly having to recalculate. And if you miss a payment or make one mistake, it could completely backfire and just fall apart on you. It's like it's delicate because you're relying so heavily on all these different inputs on your end to make the strategy work. Like I feel like I have to jump and show you something because it doesn't make sense to me, the math. Like looking at, let me see if you can see this. When I see a lot of homeowners, you just bought a home for 330,000, right? And you're a newer homeowner and you see this velocity banking concept because it seems like the most common trend I'm seeing when I talk to customers that ask me about velocity banking, they seem to be new homeowners, right? And they want to
Mm.
own. And there's nothing wrong with building equity and getting to a position where you have that higher net worth, right? But that takes time. And there are ways to get there faster than sticking to your normal 30-year mortgage, right? So say, for example, you bought your home for 330,000, 10% down, you got it at a 7.5% last year, right? Like just actually, you know what? Say it's this year's market rate, 6.5%. So this is your normal mortgage, right? $1,900 a month. If you're doing very fairly well, because it seems like it's everybody that's interested makes decent money or has has a really good income, right? So you're middle class, you're upper middle class, you're making 100,000 a year. So this is a drop in a bucket for you, right? It's like 18% of your income is going towards grossing. 18% of your gross income is going to your mortgage. You have plenty of savings opportunities, right? Instead, like, but the math is so simple. There's nothing complicated about it. Like just an extra $100. You just shaved off 4 years. Just uh, easiest hack, Jason. Pay an extra $100 a month. I'm gonna now save 4 years off your mortgage, and you just got $61,000 you could put away over time to your investment account, and that's just $100. How complicated was that, Peter? Was it pretty hard?
Yeah, but I would
Could
like
have-
to have the extra $100 in my pocket now, Jason.
I would too. But let's say you're that person that makes 100,000, 10,000 a month, right? Let's throw $500 at it. What does $500 do, right? Because you're gonna go wild. You're able to afford to do that because you can sacrifice it. That knocks it
Mhm.
down to almost 13 years off your mortgage, and you're really good about it. And you want to be the crazy person? Throw $1,000 at it. You own it in 13 years. You're the brave soul that can put half the income away because that's what velocity banking is doing. Let's double it. Let's just add 2,000 to it. Now you own your home in 8 years, right? But while you're doing that, you see how quickly you pay off your home. You just basically saved yourself the purchase price almost by doing it. So there's nothing simpler than just making additional principal payments, right? but no one
Mhm.
wants to hear it. It's not sexy like velocity banking. Let's call it like velocity home ownership. Pay more towards principal. Like it's just wild to me because like as I see and hear more and more about like these hacks, it's like it's the person delivering that hack is like a hack. It's just, I call BS because it's like, it shouldn't be that complicated. If you're able to put away $2,000 a month and you can commit to it now when you don't have kids yet. I'm assuming this is again assuming you're an early homeowner, you don't have kids yet, or you may have little ones. You can sacrifice a little bit more now so it pays off later, right? Because I think people that do the velocity banking like the concept that they can have access to equity potentially, right?
Mhm.
But again, if you pay that 100, 200, $500, whatever you're comfortable with towards extra principal now, while you know you can,
Mhm.
that just helps build your equity sooner. And if you needed that rainy day fund, then yes, shameless plug. You can get our fixed rate HELOC for that purpose to reaccess equity while you're continuously paying it. If you need that peace of mind or that backstop, but you don't
Yeah.
need to do it in such a complex way with velocity banking.
Yeah, I mean, the idea of velocity banking is you're using someone else's money to pay your loan, right? So you're using a loan to pay a loan. But that both of those loans are being facilitated by one income,
Mhm.
right?
Yours,
It's your income. Yeah, your
your
income.
household income.
It's in either direction. It's not going to change. So why you're double leveraging yourself? And I guess some people might think, "Oh, I'm already leveraged once. Why not just do it again? Because it's the same collateral, right? If I'm late on my mortgage, I'm gonna lose my house anyway. So why not just double up?"
In a funny way, it also sounds like the person that's renting and using, oh, I'm sorry, not you, Peter, but the the friend that's renting, right? That doesn't want to buy a home, like, and argues that renting is cheaper because they're trying to justify their decision. I'm not. It's like some people have a really good rent. It makes sense, but like home ownership and investment is very important too. And like there's no shortcut to owning your home without a mortgage. So for me, it's like I hope people understand, like our audience, it's not just about getting loans and getting lines of credit or mortgages. Like one of the things that drive me and Peter, I think, is the fact that we want to make sure our viewers and the people and customers and clients that we work with have the ability to get to the point where they can own a home outright. Like, which is the exact opposite of Mr. Kiyosaki, right? Leverage yourself to your teeth till the day you die.
All right. I think we should move on to number three, to point number three now. Opportunity cost. When you do velocity banking, there is something that you are giving up. Um, the ability to get a HELOC later when you actually might need it. Like, can you get a HELOC on top of another HELOC?
You could, if you can income qualify it for, it's like
Mhm.
if you're doing interest only HELOC and getting another interest only HELOC, it technically could be possible so long as your income was strong enough and you were able to pass through that underwriting.
So you're telling me there's a chance?
Most likely not. So you're probably looking at getting a HELOC to replace it with another HELOC. So you're refinancing into a new HELOC in most cases. Technically, you can get up to 3 HELOCs depending on the lender.
Mhm.
But what are you doing? Well, if you can qualify for all of that, why are you making your life so damn complicated with this velocity banking? Like, it's like,
Why? Why? Why?
why do you need to manage so many different mortgages like that in that regard to get ahead? You're not getting ahead if it's that complicated.
Mhm.
Get a mortgage, pay extra because you'll have two sides working on your end, or two things working for your benefit. You with your higher income with disposable income, paying it down now, and you get to see the appreciation in your market and the upside there. And that gap becomes bigger over time naturally because every payment you make, additional principal plus the appreciation will just continue to grow. That's where you have access to your equity.
The final point is velocity banking, the way it's set up, it gives you this false sense of security, like the false sense of control, because you have this line of credit that you have access to, and then you are now in control of speeding up your timeline into building up equity and then getting yourself into financial freedom. It sounds nice, but in reality, it doesn't really always work out that way.
You're going to end up being a victim of velocity banking if you don't execute it properly.
You know what you do actually have control over is your spending. What you do have control over is how you make
Yeah.
your payments. So, you
Mhm.
know, it might not sound sexy or it might not sound glamorous, but that's actually what you do have control over. So instead of looking for security in having a line of credit to a large sum of money, be secure and be in control of your own spending, your own habits.
Or take that extra project or shift or get that overtime, whatever you can to increase your earnings and put that towards your mortgage,
Yeah.
right? Maintain your lifestyle. Do something different with the time you would have spent trying to juggle all of that velocity banking, because that's going to feel like another job in itself, in my opinion. Make that be what gives you the freedom to pay and own your home sooner, right?
I think if we boil down the essence of what the mindset of velocity banking is, it's you suffer a little bit now, which is you dump your paycheck into a HELOC and then you use that to accelerate this goal of home ownership so that you can later get access to your equity and then you can do more with that equity later, it's like leverage it later. If that's the idea that you're comfortable with, then simply just put your extra money that you would have put towards a HELOC into your first mortgage, your principal now, like what we like the graph that Jason was showing you. The beauty of that concept is the later on you get in your life, most likely studies show that income will improve over time, right? So if you've been paying off your mortgage and then some extra for 15 years, by the end of that 15th year, when you do own your house, your income is not going to look the same most of the time. Usually it's going to be a lot higher. Dude, you're in such a good position to go investing, to use now pull out your equity or to go to get a second house. Like there's so many things you could do at that point.
And it doesn't mean it's going to be in 15 years, right? Because like again, I know we're talking about at the end of this video, but when it comes to velocity banking, the principle is you're putting your full paycheck in. So you're not having a savings account. Your HELOC is
Right.
your savings account. So when I say, even when I gave the examples, don't get it wrong, like $100, $500, right? That's not a large portion of someone's earned income, right? That's a small amount. And that was done on purpose because I'm telling you, that small amount, it grows over time. It's compound interest. It's simple math, right? It's the not sexy math in investing. But that $100, that $200, the $500 each month, when you let it go over time, has a huge snowball effect. And on a $300,000 mortgage, $500 a month extra, and that sounds like a lot, is 200 grand in interest saved in today's market rate. You're going to
Right.
own your home in almost half the time.
Let's wrap it up for people. Here's a takeaway. Velocity banking isn't some miracle strategy. It's extremely high risk and high effort. And I think we made it very clear that there's another way to essentially get the same effect, which is just pay additional towards your principal. And you got to remember, don't just send a check to your bank. You have to make sure you say this is towards the principal.
And then it's just like use the HELOC strategically, right? Don't use it with a gimmick like velocity banking. If it backfires, that house of cards you just built is going to fall apart. So it's the last thing you want to do is risk the roof over your head over a gimmick, in my opinion, like this. So it's not, just to reiterate, we're not advocates of velocity banking. It isn't a miracle strategy. In my opinion, it's high risk and very high effort way of doing something that could be done much more simply. And all it takes is just applying additional principal payments towards your current mortgage. And again, if you want a HELOC because you have the equity to do so, we want you to have a plan that makes sense long term. If you are considering a HELOC, please reach out to us. Peter, Nikki, and I, we're looking forward to helping you with our fixed rate HELOC program. It's very easy, doesn't hurt your credit. We only look at a soft check to see if you're approved. And again, it's designed to get you access to your home's equity quickly and fund very rapidly.
All right. Thanks for watching to the end, you guys. Really appreciate it. Subscribe if you haven't yet. And we will see you guys on the next one. Bye-bye. And if you want to know whether or not a HELOC is the right choice for you, we just did a video on that. It's the top one. You can click that right here. Or if you want to learn how to avoid the most common mistakes people make with HELOCs, click on this bottom video here.